So it's not that you're being squeezed because you're a bad person or you did something wrong spiritually or there's something wrong with you or there's some sort of curse on you. Stop with that mess. No, you're being squeezed because your money is not keeping up with the rate of inflation. And part of it, what the wealthy and the affluent do, as we're about to get into the next presentation, part two for tonight, they utilize the respective different life insurance paths to kind of hedge themselves and to create those buffers and have added weight and have added things that you can have access to depending upon the type of thing that you have decided to put your premium dollars in monthly into. So now, with that being said, we're about to go into the next presentation. Miss Johnson, can we see my screen?
It's still clearing. Yes, now we're good.
Okay, I'm going to read the title, and if you can just read the first paragraph for me. So the title of this is Term Life versus Whole Life Insurance. Because remember, there's so many different life insurance. There's a myriad of stuff, and that's why we're going to take probably at least the next 3 to 4 weeks to really go a little bit more in depth. Right now, we're going to go in depth today about term life versus whole life, but there's variable universal life. There's IULs, there's key man, there's survivorship, and it's not to say like, you know, to not to give them their props. All of these things are part of what allows for wealth transfer to happen. So as we're starting to bring these conversations and these thoughts to the platform, it's about us recognizing that, look, we can be well versed in these things, so we can be informed choices, so we can be like that Sims commercial that I remember from the 70s and 80s. Yes, I'm dating myself. An educated consumer is our best customer. Miss Johnson, can you please read the paragraph?
Term life and whole life are two of the most common types of life insurance policies, providing a tax-free payout to your loved ones if you die. Term life insurance is simpler and cheaper, ideal if you mainly need income replacement for a specific time, like while raising kids. Whole life insurance provides lifelong coverage and can act like a tax advantage retirement savings plan with a guaranteed rate of return.
Thank you so much. Thank you so much. Now, term life insurance coverage for a predetermined period, as you saw in the previous slide, and I'll reiterate here. You can get between usually 10 to 30 years, and some companies may even give you a 40-year if you're so blessed. But from my standpoint, I'm not here to tell you what I would do. I'm just here to share the information. But coverage for a predetermined period, so that means usually 10 to 30 years, more affordable with no cash value accumulation. I want that last part of that sentence to be buried in your head, with no cash value accumulation. You can't withdraw or borrow against the policy while alive. Now, let's move over to the next side. Whole life insurance. Lifelong coverage with an investment component that grows over time. Significantly more expensive, but builds retirement wealth through cash value. And of course, I'm bringing you this presentation today. And why is that so important? Because sometimes you can see those commercials out there, and we're not here to promote anyone's product. They're not bringing any resources to us. And you see them when you see them. But you have to make a definitive toll. And I remember a wise man once told me, and I overheard. He said to us in a circle, he says, there's certain things that are good for you that are never advertised, that you have to search out, because knowledge and power is never given. Knowledge and power has to be taken, and if you're not willing to take it, you will never receive it. Now, it may sound like that's kind of cold or it sucks, But when you really break it down, it's not really, because you're taking the emotion out of it. See, when you make your money emotional, that's when everything starts acting real funny around you. That means that's when, as we can see in this current economic stasis, there are people who are running around and they have the right to be a little disturbed because their money is not catching up to the rate of inflation. So they're feeling the squeeze. They're feeling that pressure. They're feeling that undueness. Now maybe, those things that they purchased that maybe they didn't need and they just did it as a want. Now all of a sudden you still paying on it. And it's like, wait a minute. Did you pay like 1.5 times or double the amount of what that thing is worth? Because you may have leveraged it and put it on credit because you made a bad choice and you're still paying for it at this particular moment. Now all of a sudden you stuck there and you're holding your head. That's why it's about making the right choices. Now, term life insurance. As we get this screen, excuse me. Let me go back. I apologize. Yes. Term life insurance. Coverage that fits your timeline. Term life insurance covers you for a set period. It could be 10 years. It could be 15 years. It could be 20 years. It could be 30 years. And as I stated earlier, sometimes, you have some of those companies will say, yeah, we'll give you a term package for 40 years. Like, yeah, I'm covered for 40 years. Okay. If you die during the term, your beneficiaries receive a tax-free death benefit to replace income, cover funeral costs, or pay off debts like mortgages or student loans. If you outlive the policy, it expires with no payout. I'll say that again. If you outlive the policy, it expires with no payout. So now, some of you have heard some of those cautionary tales where people, thought that they had something and, they recognize and they got a little information, say, okay, yeah, I'm gonna borrow something from that term policy. I got a situation here and I may have a $250,000 policy like how we have in this explanation. And I'm gonna take some money out so I can take care of this and I'm just really borrowing for myself. And they go to their person and say, yeah, I need like $3,000. I'm gonna take $3,000 worth out. And they're looking at themselves. You can't take anything out. Please keep paying your premium. You have a term life insurance policy, which means we're just here covering you in the form or in the case if you die. If you don't die, you didn't die. Now, the insurance, now you may hear me say that, but oh my God, did Dr. Clarke say that in a way where it felt like it was just matter of fact? Yes. That's the same way that they're going to express that to you. As we see that Mr. Sampson has his hand raised. Yes, there we go, Mr. Sampson.
Yes, I just timed out this January. Just timed out of $1 million.
Jesus.
Now, if I wanted to keep it, I'd have to pay about $2,800 a month. But so what I did was I reduced it I converted it and I reduced it, the benefit, and now I can continue with something that goes to my death. But I just wanted to let people reiterate, it's like a car lease. You bring the car back, they owe you nothing, you owe them nothing. Once you're done, you're done. I just timed out, and you can't tell people you got $1 million because they might bump you off before you turn in. All right, I'll talk to you guys. Bless you.
Excellent, excellent. So as he said, you see, that's not something that you just hear me share as because I'm doing this presentation. And see, thank God, at least Mr. Sampson had the herewithal and the common sense and also the information and the knowledge to be like, yo, wait a minute, this thing's about to time out. Okay, let me figure out a way to be in conversation with them, and transform it into something else. which he probably transformed it into a whole life, which now, as he stated, now it keeps going. He might be paying a little bit more, but at least he knows he has that benefit. It may not be as high as what the term was willing to say if he would have transitioned during the period of the time of him holding on to that term. But now, as we see by the example, for a 40-year-old with excellent health, because remember, some of these times they probably want to give you, certain health benefits, or send a nurse to your home, check your blood sugars, this, that, and the third, because they want to know. If you look like you're going to keel over tomorrow, people don't want to give you $1 million policy when you may have two years to live or 3 years to live. That means within those 3 years, your family's going to benefit from $1 million because you knew you was going to die in 3 years. So they're going to do their diligence. And that's not them being harsh. This is business. We're talking about resources. We're talking about the ability to create something that can be a wealth transfer. They have to be scrutinizing. So for a 40-year-old with excellent health, the average 30-year term policy with $250,000 of coverage costs just $27 a month. Doesn't that sound wonderful? Just $27 a month. And for women, because women are always a little bit cheaper than men, it's only $22 a month. Ooh. Instead of you going to your favorite coffee shop, you just say, okay, I'll sacrifice some of my coffee and get this. Yes, nice. And as it says on the bottom, affordable premiums. Term life is significantly cheaper than whole life, making it accessible for families on a budget. Wonderful. Simple coverage. Straightforward protection with no additional accounts to manage. Just pay the premiums and you're covered. That bill comes in, or you get that in your email. Most things are moving towards, paperless. I was, oh yeah, I gotta send them they $25 or $27 a month. And you think about that, that's $27 a month, that's $324 a year times 30 years. It's not a major expense. But it does kind of suck that for that 40-year-old with excellent health for 30 years. So that means when that person is really around the time that he's really starting to pull, maybe if he took care of himself, his Social Security, he's going to be in the same boat that Mr. Sampson just alluded to by giving us a real life example. Like, wait a minute, no, wait a minute. I had $250,000. Well, if you want $250,000 now at age 70, knowing that you've already experienced most of your life, it's going to cost you more money. Because we know you're towards the tail end of your life. You're more closer to the grave than you are to birth. So we will charge you more. And of course, they have flexible terms. Choose a term matching your debt obligation, like a 30-year policy for a 30-year mortgage. That's what sometimes some banks will love to do, especially at closing. Like, oh, you want to open up a term life insurance because, to match this and to stand the third. But like, as we've noticed, this is not the 1990s when you can find a home in New York City still in the ones with a one in front of it. And I'm not talking about 1 million. I'm talking about like 100,000 or 100 something. Those days are over. So this is term life insurance. It's very simple. It's very to the point. It allows you to be with the regular people. That, like as Mr. Sampson said, you can, and and then you won't say to everyone, I have $1 million worth of life insurance. Oh, look at you, Mr. Rockefeller. Okay. But if it's term, that means when that term ends, you no longer have whatever that amount is. So it's something to think about. Now that's term. Now we're going to whole life insurance. And once again, I'm going to ask Ms. Johnson if she can read just that first simple paragraph, because whole life insurance is a lifetime protection with cash value. Ms. Johnson.
Whole life insurance is permanent coverage that lasts until you die or stop paying premiums. Beyond the death benefit, it includes a cash component that grows at a guaranteed rate, money you can access while alive through loans or withdrawals. However, this comprehensive coverage comes at a significantly higher cost than term life.
Now, think about that. Think about that. Wait a minute. You mean to tell me if I have some whole life insurance, say 200,000, 150,000, 300,000, whatever the rate is, and I'm paying whatever it is per month. Wait a minute. You mean to tell me if I had to say if I had that same insurance for like 6, 7 years, and that cash value, and you get your statements, you see that cash value has grown. All of a sudden, as that cash value is growing, it's letting you know, like, wait a minute, this is what you have access to if you so choose to pull out. So say we have $150,000 in whole life, and you get into a little situation. You say, oh my God, I need 10K. I need $10,000. The cash value in your whole life, say around 15 or $16,000. That means they're letting you know you have about $16,000 in value that has been growing at a guaranteed rate, the value you can access. And even if you decide to pay the money back, or if you choose not to, that just lowers your death benefit. But if you decide to pay it back, you actually are paying yourself back. Because whatever the interest is, if you're paying it back to them, you are paying yourself. That's why we even go back to something that Mr. Guthrie has shared last week. The reason why people love real estate or getting into real estate as a part of their liquidity is not being just taking all their money, dumping it in real estate so they don't have no cash flow. It's about recognizing the tax benefits of saying you have something that's generating like rental income and stuff like that. And then you have depreciation costs, you have amortization, you have all these big old words, these wonderful words. Start to recognize, like, wait a minute, I own this real property, but I'm hardly paying anything in taxes. And you say, those some bad people. They robbing people. No, they're not. They learned how to play the game properly. And this is the reason why whole life insurance is about you playing the game properly. So the benefits of whole life. Lifelong protection that never expires as long as you pay the premiums. Cash value feature that grows tax deferred and can fund college, home repairs, or retirement. Fixed premiums that never increase throughout your lifetime. So say if you got a $500,000 policy, as we see when we get to the drawbacks, and it may seem like a lot that in that particular example, it talks about over $500 a month, but just hold on a second. And the tax advantages on cash value growth through loans and death benefits. Because the tax advantages is, remember, it's a tax-free wealth transfer. You transition, your heirs or your beneficiaries get that money without having to go to the IRS and go through probate and go through all the other stuff. They, okay, we see your name is here. We see all the okay, this person lived a great life and decides to go on and be with the Lord. Here's your check. Now the drawbacks to consider: higher premiums. A $500,000 policy for a 35-year-old can cost over $500 a month. Yes, but if you think about it, as Mr. Sampson alluded to, another great possibility about that whole leasing of a car. If you're willing to pay $500 a month into a premium that gives you and grows in cash value tax deferred, and as they stated, something happened and you come into a little bit of a situation and you need access to some cash. All of a sudden, you have this asset, because this whole life insurance is an asset. You have this asset that you can tap into. Coverage complexity with cash value, dividends, and loan components. Low rate of return compared to self-funded investment accounts. Yeah. And surrender charges be canceled within the first 10 to 15 years. Yeah. You surrender it too early. Yeah. But see, the wealthy and affluent know that they're not surrendering those things. They recognize whatever resources come in and says, okay, this part of the cash flow that we have is going to pay these particular things. Because these are the things that's going to protect what I'm making. Now, we're going to go down to the bottom. High net worth individuals they use whole life insurance to provide tax-free wealth transfer and additional retirement savings, especially if you max out your 401k. So it's great for those if you even work in the corporate world, why not? You make your investments with your company, if you work for a corporation and they're doing matching and all other stuff, and you go to the max and you're over here and you have something else here. And even for some of you might work in the city or work for certain, when you hear Aflac or you see those commercials, those are variations of whole life. It's not about term. Aflac is not no term stuff. Parents of disabled children ensures lifelong financial support for dependents requiring ongoing care after you're gone. You can have that stipulated. You're not sitting there worrying about that individual that you love who may need some assistance. And it doesn't lessen who they are as an individual being, but it shows your herewithal and your recognition that, I created this possibility to make sure that they're still covered. And small business owners helps with succession planning, covering estate taxes, and allowing partners to buy your shares. That goes into where certain companies, as they start growing, they start getting key, like a Mark Zuckerberg for Facebook or Meta. Believe you me, they probably have some key man insurance on him that it'd be a crazy number. But that comes out of what the company profits they make to make sure that if something was to happen to him, okay, they have that particular policy, and that policy goes into continuing the funding of the corporation, along with whatever stuff that he already has set up as a high net worth individual to make sure that he's covering his family. It's business. It's not selfish. It's not waiting for someone to die. It's recognizing how it is that you're using the resources that you have at hand to now, as Miss Nicole Johnson's question earlier about leverage, now how are you leveraging your money in a different way? It's still leverage. This is still leverage. This is another form of leverage. Now it's not the debt side. Now it's about accumulating. And if you position yourself in enough stuff that's accumulating or growing, or you're investing in stuff that keeps growing as an asset, it means your net worth is growing. It means you have more to protect. Just something to think about. Because these are not the type of conversations or things systemically, especially in this country, that we weren't well positioned or well thought out or well expressed into. That's why even last week, as we celebrate Dr. Martin Luther King's birthday, one of the things in his last year of life, he started to recognize, did I bring my people into a burning house? We got the Civil Rights Act, we got the Voting Rights Act, but we ain't got money. We're not moving in the same possibilities of particular circles that other communities are doing. So yeah, you get to feel good, mother. You standing there, you get to vote. Yes, baby, we're gonna vote today. Even though we know how some of them people may feel about us. Okay, where are the proceeds? Where are the resources? And we know America has lied plenty of times, because remember, we can go all the way back to Reconstruction when it was supposed to be 40 acres and a mule. And they reneged on that. So do you think that they're going to give you power or a possibility to access power? They don't just hand it to you. Oh, but you've been very good people. Let me just hand it to you. No, they don't do that. They'll never do that. Anyone with I hate to say it, anyone with some common sense would never do that. There's no benefit in it for them. And as we move to the last slide for tonight, which policy is right for you? This is where you start to make the choices for yourself. I'm not here to tell you which one to do. I know which one I would get. But to be respectful, because everyone is at their own respective space and place. Your budget. That's one of the first things you should look at. Term life is much more affordable, making it ideal for those with limited funds. Whole life costs more, but provides lifelong coverage and cash value. You'll make a choice. You'll probably start to figure out, what do you think your life is worth? And that's not me being disrespectful or thinking that somebody's life is worth more than someone else's, but it amazes me that when you start to really look at high net worth individuals or people who are wealthy and affluent, part of their strategy for legacy building is to make sure that they have these different types of policies that when they know it's time for them to leave, they got stuff set up. And leaving it to the right people. Financial goals. Need simple protection for a specific period? Choose term life. Want to build cash value and have lifelong coverage? Consider whole life. Retirement planning. Whole life's cash value can supplement retirement savings. If you've maxed out your 401k or IRA, it adds stability and diversification. That means if you have hit those matching marks and you're getting to that point, depending upon if you have a Roth IRA, and we're going to get into that over the course of the year as well, because those are retirement accounts as well, depending on what type of retirement account that you're in. Some force you starting at 59 and a half, you can stretch it out to maybe 70 and a half, even Social Security now. You can defer and not you can take it as young as 62 and you can wait as old as 72. You wait as old, and if you're taking care of yourself and you wait till 72, you're going to get a higher cash value benefit because you didn't take it at 62. So that's choice is yours. And as Mr. Sampson eloquently, and we thank him for giving the example about how he converted his term to a whole life insurance policy. The convertible term life insurance policy lets you start with cheaper coverage and transition to permanent coverage later without a medical exam. There are those out there. This is beneficial if your financial situation improves or you develop health issues that make new coverage difficult to obtain. There's no one size fits all. Look at your own respective lifestyle possibilities, what's going on with you. All of that comes into play when you're making these respective decisions. Now you're thinking, not just emoting. You are thinking. And it's okay to be a conscientious thinker. Benefits of conversion. Coverage flexibility as income rises, no medical exam required. You lock in the premiums early. And conversion drawbacks about converting term to whole life. To give you that as an example, significantly higher costs, of course, when you make the conversion from term to whole. Limited conversion periods, they only do it so often. It's not like, you can do it today and be tomorrow. Still more expensive than term renewal. Yeah, it's going to be more expensive than a term renewal. Because number one, the term renewal is going to be at your present age. So say if you had like a 15 year and 15 years have passed and you're still alive. That means you go get another 15 year. They're not going to give you the same rate that you was when you were 15 years younger. So that means say you got that at 27, you're now 42. Now when you get that next 15 year, it's going to be based on you being 42 years of age, which means it's going to be costing you a little bit more. And the bottom line, both term and whole life insurance offer a safety net for your family, but they work differently. Term life is affordable for temporary coverage, while whole life provides lifelong protection and builds cash value at a higher cost. The best choice depends on your financial goals, budget, and long-term needs. And the reason why we have to continue to have these type of conversations, because when you hear someone talk about, maybe we should be talking about the life insurance conversation. No one's attempting to kill you off, unless you're around some really shady individuals who are just saying like, wait a minute, hey, you running around here talking about you got $2 million worth of life insurance. There's enough stuff on some of those crime channels to let you know, like, wait a minute, that person got killed off because of his insurance. Well, his insurance was about to last, and all of a sudden he got murdered. Not saying that that's going to be the scenario, but just recognize that you're allowing yourself to be aware, and that everything that they attempt to put in your face as a big, song and dance may be the one for you to jump into. And with that, I am complete. Any questions? I saw a bunch of stuff in the respective chats. Okay. Okay.
My brother.
What's going on? So why don't you talk a little bit while we have a couple of moments? Because
Yeah, I just wanted to definitely touch on that part where you were saying hopefully no one wants to bump you off for the money. A lot of people, I, I have to educate families that there's a incontestability clause on all policies. They have to be in effect for 2 years
Mm.
before there will be no investigation. Within the 2 year mark, and I mean from a year to 364 days, the insurance company can do an investigation to make sure that the application was accurate, that there was nothing withheld, there was no medical condition that wasn't revealed, and it's for their protection. Because, like we alluded to earlier, if you know you had a known condition, you can dump, a few $1,000s into something knowing that you'll return $1 million in a short period of time. That's one. Just wanted to make people aware. All policies, term and whole life, have to be in effect. They tell you you're covered, and you are covered. But after 2 years, no investigation. Before the 2 years, they have the option of returning whatever payments you made. And that's it, not paying the full death benefit.
Wow. Okay.
They have the option. Now, I've seen where someone may have lost their life through an accident within the 2 years, and they paid the full amount. But if it was natural causes, they have the option of asking you to submit a doctor's report and do an investigation. So chances are you won't be able to use it for your services. And the last thing I wanted to, let's just say let's imagine I had 3 successful children, and I just timed out of my $1 million, and I told my 3 kids, listen, it's $2,500 a month. If you guys can kick out $830 a month each, if they did that for even for 10 more years, they only would have spent 30 grand.
To get $1 million.
No, excuse me. That's incorrect. It's 30 grand a year. For 10 years would have been 300,000, but they're still going to get 700 grand. It's a number game. It's a numbers game. And there are other cultures who do insure their parents, knowing that the proceeds upon their death are going to far exceed what they put out. Now, could you just imagine, which I know my brother's going to cover, and that's why I love him to life. Could you imagine if the trust was paying those payments? If the trust was paying the $2,500 a month, knowing that $600,000, $700,000, $800,000 was going to come eventually. So now you're not feeling the 25, you're not feeling the $830 a month as an individual. The trust is covering it. But now all this money comes back into the family. There's all kind of guidelines on who can access it and how much and how and when. And you're living lovely. Hello, Rockefellers.
Mm.
Hello, Vanderbilts. So I know you're going to cover it, but I just wanted to drop that seed of interest. And I miss you guys immensely. And thank you for entertaining me tonight.
Oh, no. The pleasure is ours. The pleasure is ours. Mr. Guthrie, because I know you're into real estate down there in good old Kakalakis in the Floridas, getting the chance to experience some northern temperatures.
Yeah.
What would you say to this in regards to even from a real estate standpoint?
I think I unfortunately wasn't allowed myself to become very aware or educated concerning previously.
Mm-hmm.
But now it's ironic that I'm in this very moment studying. And I said with knowledge comes potential for transformation. Potential. Everything that Mr. Sanchez just mentioned a while ago is I had to smile, because the more you study wealth and the wealthy, you realize that this is one of the most, insurance, when I said this, is one of the most effective, user-friendly, tax beneficial tools to not just transfer wealth, but grow wealth, because you're getting the benefit of more than what you put in. And imagine a situation where they leverage the cash value into things like real estate and other instruments that, even though it might be taxed on the interest, for example, maybe taxed, not the amount itself, but the interest that you generate from whatever you do is taxed, not the entire amount. So there's many, many layers and levels to this. And especially when you consider situations of thinking generationally and thinking empire building, thinking that type of way, you can perpetually grow, protect, transfer wealth indefinitely. That's what many of the families, what Mr. Sam just mentioned, has done. Generations are eating off of funds that they never generated themselves. And even the forefathers did not generate all of those wealth. The instruments that were employed, multiplied, protected, preserved, tax sheltered, tax deferred, because many, you get what I'm saying? There's a different language to this kind of, that's why consistent growth, development, and education is absolutely necessary. Education is not a one-off thing. Certain cultures are fed that, oh, go to school, get a job, get a career. No, that is a form of confinement and containment. But true education is eternal. Thankfully, I have a mom that inspired that in me from a very early age, to be a consistent learner, because what you learn, you own. You can take money, for example, but you cannot take someone's knowledge. So I am very, very thankful that I finally begin to prioritize learning that aspect of wealth, because I didn't think about it. I didn't focus on it before. But now that I'm choosing to learn it, I am profoundly inspired and thankful that I am now beginning to know when you gather information, now you're in a position to operate more holistically. Because I've always been interested in entrepreneurship. I've always been interested in real estate for most of my life, really. But when I really studied the true perpetually wealthy families, they move very differently and they move very quietly. Their wealth is very quiet, but abundant and systematically leveraged, I like that word, in such a way and positioned in such a way that is really impossible for the beneficiaries to exhaust it. They don't even have the option to exhaust it because of how it's structured and how it's protected, and you can just access it all willy-nilly. You get what I'm saying? And the principle never dies. Therefore, the potential for growth never ends. So I am thankful. I had to smile when I heard you teaching on this and choosing and preempting that no, we're not gonna rush this. We can't. We have to really take our time to really marinate this and understand the power of this and operate from a place of understanding, a place of discernment, and a place of true wisdom. Thank you.
Oh, thank you. Thank you. Miss Clarke. Let me go to Miss Clarke. You know, I remember the teacher would call my last name like that, but like it sounded like you almost saying clock instead of Clarke. So let me go to Miss Karen Clarke, my elder sister, and just see where is she here, what landed for her today, or if anything did land today. You can open up your mic, Miss Clarke, so we can see where you're at in regards to how we landed on this responsive conversation, because these conversations are needed. And a lot of times we can be so disparate as families. I'm talking about blood family. And that also can be a hindrance for wealth to be propagated long term. Because like when you start to hear, as when Mr. Sampson was talking about, the Vanderbilts or the Rockefellers, and you're talking about the Rockefeller Foundation. It's crazy. John D. Rockefeller died in the early 30s, somewhere around there. First billionaire. I mean, come on. They can't even spend all that money. Ford Foundation, when Ford died, he left his family billions. But then they created other tax shelters, like the Ford Foundation, things of that nature, where, you start to wonder why when some of these people start to get some wealth, or we bring it to even fast forward to today, where, someone like a LeBron James who has the LBJ Foundation. You're like, why do these people got foundations? Isn't it just, I'm saying, they made millions of dollars, doing whatever they did, and aren't they just enjoying their money? No, there's a different level when you're really talking about being wealthy or affluent. See, too many times we as Black and brown people desire to be rich. That is so small. That is playing such a small game. Oh, I want to be rich. I want to be better than these other people. I want to make sure all my bills are paid. Oh, you want to be rich. But I always go back to something that Shaq said when he signed that contract with the Lakers, when he left Orlando in 1996 and decided to go to the Los Angeles Lakers. He said one of the things, he had a conversation with Magic. Magic said to him, says, look, Doc, you about to get some generational changing money. And one thing I can say is that Dr. Buss, he pulled me under my wing. And it's not so much that he gave me the resources, he gave me access to the network. He gave me access to the network. You can talk to these people. That little old man over there who looks kind of feeble, you want to talk to him. That dude over there is probably worth billions. But he's so unassuming, as we said. He will walk down the street and people look at, hey, look at that feeble, oh, look at old man, ugly, and you say all the other stuff that just shows that you're moving in an emotion. It's like, wait a minute. So as soon as that man opens up his mouth, it's like, wait a minute. You're worth what? You don't have the big dookie chain and all these. Wealth and influency whispers. Doesn't have to be loud. Whispers. Gives yourself the opportunity to be, very refined. But see, most times for Black and brown communities, they like to give us this picture about, looking affluent. And you come to find out the affluent don't even look like that. Or the stuff that we think that makes us look like we have something. And the people who do have, sitting there says, wait a minute, I wouldn't. Now, no, mind you, like I say all the time, affluent people will circulate their dollars on certain things, and they do buy clothes, they do buy high-end stuff. I know there's plenty of times when I go to my local premium outlet, there's certain stores that, as I've started to learn about what some of the, not the rich, but what the wealthy and the affluent circulate their dollars on. You got stores where you can go in there and be like, oh, this is just a little, quarter zip sweater, and it's not $100. It's like, the hell is this? I might as well go to this store over here and spend $50 for it. It's different quality, different level. The same reason why you don't see Rolls Royce or Bentley advertised on the TV screen, or Lamborghini. But people still buy Rolls Royces, Bentleys, and Lamborghinis every year. In the same way, you should wonder when they're always pushing certain products in your face for mass marketing. Then after a while, you mass market it, you got those resources, you start to make your investigation known. Like, okay, how do I really find out? How do I hold on to my liquidity and not even make my liquidity work for me? What is that I need to be invested in? What are the products that's going to allow me to grow? And going back to Shaq, not to keep that story in limbo. And Shaq finally decided to sign that deal with the Lakers, 7 years. I think it was like $120 million. Life-changing money. And he said he had one conversation with Dr. Buss and made him say one of his famous lines. He says, after really spending a day with Dr. Buss, and he said it was like 5 or 6 other individuals in the room, that's when he knew that he was still only rich. Shaq. He already made like $50-60 million Reebok deal. You know what I'm saying? He got some good money, not long-term, changeable, generational money, but a good start. But he recognized that time that he was still rich, because he said, wait a minute, if someone can afford to cut me and pay me $120 million over 7 years, and I can't do that for myself, I am not wealthy. I'm just rich. Now, what I'm going to do is I'm going to find out, how do these people become wealthy and affluent? Which, if you do your own investigation, I wouldn't be surprised, Ms. Johnson's probably the quickest when it comes to the research here, especially with her anointed intelligence. You'd be surprised how wealthy Shaq is and what he owns and the diversification of what he owns. Good night, Karen. Get some rest. I know you probably got work in the morning. We're about to close.
Good night.
Good night. You just got to be mindful. You have to be mindful. Certain things is not about rushing. That's why next week we're going to continue we're going to get into, variable universal life and IULs and all that stuff, because we want to take our time. See, initially this was only going to be like, a couple of weeks and, real surface. And no, a true dynasty path means that we're building a conclave of information that are resources that we can go back to and refer back to. That now, if we choose to start to apply some of these tenets and possibilities, now we're starting to see, wait a minute, I'm starting to see there's some wealth possibilities happening. Because my choosing power is much more adept. So, Shaq has made it to the wealthy. Net worth $500 million. Business holdings, Big Chicken, Papa John's, Krispy Kremes. Yeah, the list probably goes on. Let's see. Yeah, Krispy Kremes, former large franchise owner. Yeah, Five Guys, car washes, fitness centers, tech investments. He owns pieces of hotels. The General, he owns a piece of that. Papa John's. Owns a major piece of that. So you start to recognize there's different conversations to be had. And insurance is one of those things that allows us to be expressive. So as we start to bring this to a close, here's the possibility to support the platform financially as we continue to utilize that to be in a space of marketing this platform, the Comeback Collective Circle. You desire to do it via Cash App, it's $ Gregory Clarke D. Min. It's via Venmo, Gregory Clarke D. Min, so that means you just drop the $. And if you choose to do it via Zelle or PayPal, just simply, same email address, esquire971@gmail.com. And the other thing that I'm going to share before I close is also for those of you who are looking for AI tools, you can use my affiliate link at galaxy.ai/ref=Gregory. You'd be surprised that not only have access to some of the tools that some of us talk about in other conversations and dispensations, but you have access to much more for a very nominal fee. So I would say definitely go visit this website, check them out, legitimate company. I have it myself, and you'd be surprised the stuff that you can create as technology is just moving ever forward. So once again, as we close out for this week, continue to be blessed. We're going to continue on in these insurance conversations next week. So make sure not only you come back, but bring others, share the links. You know, if you received the pictures that shows the Zoom link with sign on and passcode and all that stuff, please share it. Share it with others. You know, if you know individuals around you who are willing to not just absorb knowledge, but really to seek it out so they can apply it, let them become a part of the Comeback Collective Circle as we continue to grow and aspire and develop this community. So to everyone out there, until next week, we're here at the same great time, same great space. This is Dr. Gregory Clarke Sr. signing off, saying continue to keep your eye on your resources so your resources can keep an eye on you. Peace and love.
Blessings, everyone.
Blessings, blessings.